45 days. That is all you have. Not 45 weeks, not 45 months, 45 days. And in those 45 days, your $5,000 silver position is going to become $800. Not because I want it to happen, not because I'm rooting for a crash, but because three catalysts are about to collide at the exact same time. The Federal Reserve, China, and the leverage bomb. And when all three hit between now and February 15th, 2026, there will be no exit, no bounce, no recovery, just gravity. Most people think crashes give you time. They think you will see it coming. They think you will have days or weeks to react, but crashes do not work that way. Crashes happen in hours, in minutes, in seconds. And by the time you realize what is happening, the exit is already gone. Right now, silver is trading in the 70s. Retail investors are euphoric. YouTube is flooded with silver to 150 predictions. Forums are screaming about COMEX defaults and supply squeezes. Everyone is convinced the rally never ends. But what if everyone is wrong? What if the rally ended 2 weeks ago and nobody realized it yet? What if you're standing at the edge of a cliff and the ground is about to disappear? While you were reading bullish headlines, while you were stacking silver based on hype, while you were planning your exit at $100, the countdown started, and nobody told you. There's one number nobody is talking about, one date nobody is circling on their calendar, one deadline that will separate the survivors from the casualties, February 15th, 2026. That is the collision date. That is when the Federal Reserve meeting aftermath combines with China's policy window and the third margin hike hits the market. That is when $5,000 becomes $800. And if you are still holding silver on February 15th, you will learn the hardest lesson the market teaches. The lesson that parabolic rallies do not end with a whisper. They end with a scream. So today, I am going to show you something nobody else is showing. I am going to show you the exact timeline of the next 45 days. I am going to show you the three catalysts that are converging. I am going to show you why the Federal Reserve meeting on January 29th is the first domino. I'm going to show you why China's policy window in early February is the second domino. I'm going to show you why the third margin hike is the final domino. And I'm going to show you the math day by day, dollar by dollar, of how 5,000 becomes 800. Because this is not a theory, this is not a guess, this is a timeline, and the clock is already ticking. Let's begin. Part 1, the 45-day window. Why crashes compress time. Let me start by destroying the most dangerous assumption in your head right now, the assumption that you have time. You do not. Here is what most people believe about market crashes. They believe crashes are slow. They believe crashes give you days or weeks to react. They believe you will see the crash coming and be able to exit at a reasonable price. That belief will destroy you, because crashes do not work that way. Crashes compress time. What should take months happens in days. What should take weeks happens in hours. What should take hours happens in minutes. Let me show you the evidence. In 1987, the stock market crashed 23% in one day. One day. Not 1 month, not 1 week, one day. In 2010, the flash crash erased nearly $1 trillion in market value in minutes. Minutes, not hours. Minutes. In 2020, the COVID crash took the S&P 500 down 34% in 33 days. That is 1% per day, every single day, for a month. Now look at silver specifically. In 2011, silver crashed from $48 to $32 in 2 weeks. 14 days, 33% gone. In 2020, silver crashed from $18 to $12 in 12 days, 33% gone. In less than 2 weeks. Do you see the pattern? The initial collapse is always the fastest, because that is when leverage breaks. That is when margin calls hit. That is when forced selling dominates. And once forced selling starts, it does not stop until every leveraged position is liquidated. Now look at where we are today. Silver is at $75. Leverage is at record highs. Open interest on COMEX is extreme. Retail participation is at euphoric levels. And three major catalysts are lining up. So when I say February 15th, I'm not picking a random date. I'm calculating the convergence point. The Federal Reserve meeting is January 29th. That is Catalyst 1. China's policy announcements typically happen in the first 2 weeks of February. That is Catalyst 2. CME margin hikes follow volatility spikes. If the Fed meeting spikes volatility on January 29th, expect a second margin hike by early February. And if silver drops significantly, expect a third margin hike by mid-February. That is Catalyst 3. So the timeline is not random. The timeline is calculated. January 29th, Fed meeting. Early February China policy window. Mid-February, third margin hike. All three hit by February 15th. And when all three hit, the leverage unwind is complete. Now here is why 45 days is more than enough time for an 84% crash. History shows 33% can happen in 2 weeks. If 33% can happen in 14 days, then 84% can happen in 45 days. The math is simple. Week 1, down 20%. Week 2, down another 20%. Week 3, down another 20%. Week 4, down another 20%. By week 4, you are down 60%. By week 6, you are down 80%. That is how cascades work. They do not move in straight lines. They move in waves, each wave bigger than the last, each wave faster than the previous, until the leverage is gone. And by February 15th, the leverage will be gone. Now let me show you the first catalyst. Part 2, catalyst. 1, the Fed meeting, January 29th, and the hawkish shock. The first domino falls on January 29th, 2026. That is the Federal Reserve's first FOMC meeting of the year. And that meeting has the potential to destroy the silver rally in one day. Here is why. Right now, the market is pricing in rate cuts. The market believes the Fed is done hiking rates. The market believes inflation is under control, and the Fed will pivot dovish in 2026. The market believes lower rates are coming. But what if the market is wrong? What if inflation is not under control? What if the Fed looks at the data in January and realizes they made a mistake? What if the January 29th meeting delivers a hawkish shock? Let me show you the setup. Inflation data in Q4 2025 was stickier than expected. Core CPI is not falling as fast as the Fed projected. Wage growth is still elevated, housing costs are still rising, and commodity prices, including silver, have been surging. That last point is critical. When commodity prices surge, it feeds into future inflation. Because commodities are inputs for everything: energy, materials, manufacturing. So when silver goes from $22 to $75 in a year, that is inflationary. And the Fed sees that. Now the Fed also sees employment data. Unemployment is still low. Job growth is still positive. The labor market is still tight. So the Fed has a problem. If they cut rates while inflation is sticky and the labor market is tight, they risk reigniting inflation. And if inflation comes back, the Fed loses all credibility. So what does the Fed do? They stay hawkish. They push back against rate cut expectations. They signal that rates will stay higher for longer. And they might even hint at the possibility of more hikes if inflation does not cooperate. That is the hawkish shock. And if that shock happens on January 29th, the market crashes. Not just silver, everything. Stocks, bonds, commodities, because higher for longer rates mean lower asset prices. But silver gets hit the hardest. Why? Because silver is leveraged. Because silver is a risk asset. Because silver has no yield. Because when the dollar surges on hawkish Fed news, commodities get crushed. So here is the timeline. January 29th, 2 p.m. Eastern Time, the Fed releases its statement. If the statement is hawkish, the dollar surges immediately. The DXY spikes 2 to 3% in minutes, and silver drops. Not 2%, not 5%, 10 to 15% in one day. That takes silver from $75 to $65 or $60. And that is just the beginning. Because the Fed meeting is not just about the immediate reaction. The Fed meeting sets the tone for the next 6 weeks. If the Fed is hawkish on January 29th, the market reprices everything. Rate cut expectations get pushed back, the dollar stays strong, and commodities stay under pressure. So the drop from 75 to 65 on January 29th is not the bottom. It is the start of the cascade. Now add the second catalyst. Part 3. Catalyst 2. China's policy reversal. Early February window. The second domino is China, and China is the most dangerous catalyst. Because China does not telegraph policy changes. China moves in the dark. One day, export controls are in place. The next day, they are gone. And the market has no warning. Now here's why China is the key to the entire silver rally. The bullish narrative for silver in late 2025 and early 2026 is built on one assumption. China is locking up silver forever. Export controls, licensing, restrictions. The narrative is that China will never let silver leave the country again. And if China never lets silver leave, then global supply is permanently tight. And if supply is permanently tight, price must go higher. That is the thesis. But what if the thesis is wrong? What if export controls are not permanent? What if they are temporary? What if China reverses course in February? Let me show you why that is not just possible. It is likely. China's economy is slowing. GDP growth is below target. Export numbers are weak. Manufacturing PMI is contracting. The yuan is under pressure. And China needs dollars. Why does China need dollars? Because China has dollar-denominated debt. Because China needs to pay for energy imports. Because China needs to stabilize its currency. And how does China get dollars? By exporting. So if China needs dollars, China needs to export. And one of the things China exports is silver. Now, right now, China is restricting silver exports for strategic reasons. But strategy is flexible. Strategy changes when circumstances change. And if China's economic situation deteriorates in January, the strategy will change in February. Here's how it happens. Late January, China releases economic data showing weaker than expected growth. The yuan weakens, capital outflows accelerate. The government faces pressure to boost exports and stabilize the currency. Early February. During the Chinese New Year policy window, the government announces an easing of silver export restrictions. Not a full reversal, just an easing. We are expanding the list of approved exporters. We are increasing export quotas. We are streamlining the approval process. That is all it takes. The moment that announcement hits, the bullish narrative collapses. Because the market does not care if the easing is small. The market only cares that the policy is reversible. And once the market realizes the export controls can be reversed, the assumption that China is locking up silver forever dies. And when that assumption dies, there is no reason for silver to be at $75 or $65 or $55 because the entire rally was built on that one assumption. Now, here's the timeline. Chinese New Year is in late January 2026. Policy announcements typically come in the 2 weeks following the holiday. So the window for a China policy shift is February 1st to February 14th. That is a 2-week window. And if the shift happens during that window, especially if it happens after the Fed has already shocked hawkish on January 29th, the market panics. Because now you have 2 reasons to sell. The Fed is staying hawkish, China is reversing export controls. And when you have 2 major catalysts at the same time, the selling accelerates. Traders do not wait. Algorithms do not wait. They sell. And when they sell, the price drops fast. From $65 after the Fed meeting to $50 after the China announcement. That is another 23% drop in days, not weeks, days. Now add the 3rd catalyst. Part 4, catalyst. 3, the margin death spiral. The 3rd hike kills everything. The 3rd domino is margins, and margins are the executioner, because margins do not just push the price down. Margins force liquidation, and forced liquidation is how crashes accelerate. Here is how the margin death spiral works. CME raises margin requirements when volatility spikes. Higher margins mean traders need more collateral to hold their positions. If traders do not have more collateral, they are forced to close their positions. And when they close, they sell. And when they sell, the price drops. And when the price drops, volatility spikes more. And when volatility spikes more, CME raises margins again. This is the death spiral. And it does not stop until all the leverage is flushed out. Now here is where we are in the cycle. CME raised margins on December 27th, 2025. That was margin hike number 1. It was a preemptive move to reduce risk as silver approached record highs. But it was not enough to stop the rally. Silver kept climbing into early January. So what happens next? If the Fed meeting on January 29th causes a 10 to 15% drop in silver, volatility will spike. And when volatility spikes, CME will raise margins again. That will be margin hike number 2, expected around January 30th or 31st. That 2nd hike will force out the medium-sized traders, the ones who are leveraged but not over-leveraged. They will close their positions. Silver will drop from 65 to 55. That is another 15% drop, but the spiral does not stop there, because now silver has dropped from 75 to 55. That is a 27% drop in 2 weeks, and 27% in 2 weeks is extreme volatility. So CME raises margins a 3rd time, expected in the 1st week of February. That 3rd hike is the killer, because at that point, even the strong hands start to break. The traders who survived the first 2 hikes are now underwater. They are holding positions that have lost 30, 40, 50%. And when CME raises margins a 3rd time, they have no choice. They either post massive new collateral or they liquidate. Most will liquidate. And when they liquidate, there is no bid, because everyone is trying to sell at the same time. So the price does not drop 5%, it drops 20% in one day, from $55 to $44. And that is when the algorithms take over, because algorithms are programmed to sell on momentum. And when silver breaks below $50, every momentum algorithm on the planet starts selling. They do not care about fundamentals. They do not care about supply deficits. They do not care about China. They only care about one thing, the trend. And the trend is down, so they sell. And when they sell, the price drops more. And when the price drops more algorithms sell. This is the algorithmic cascade. And it does not stop until the momentum exhausts. So silver goes from 44 to 35, then from 35 to 28, then from 28 to 22, then from 22 to 15, and finally from 15 to 12. That is the bottom. $12. Why 12? because that is where physical buyers return. That is where miners cut production. That is where the algorithms finally stop selling. But by the time silver hits $12, your $5,000 position is worth $800, and the crash is over. Now, let me show you the day-by-day math. Part 5, the 45-day timeline, day by day, dollar by dollar. Now let me walk you through the exact timeline of how $5,000 becomes $800. This is not a vague prediction. This is a day-by-day, catalyst-by-catalyst breakdown. January 15th to January 28th, the calm before the storm. Silver is trading in the low to mid-70s. The narrative is still bullish. Retail is still buying. You are holding your 66.6 ounces. Your position is worth about $5,000. You're flat or slightly up. You're confident. Everyone around you is confident. The forums are bullish. YouTube is bullish. You believe silver is going to $100. You're planning your exit at 100 or 150. You have no reason to sell. January 29th, 2 p.m., the Fed meeting. The FOMC releases its statement. The statement is more hawkish than expected. The Fed pushes back on rate cut expectations. The dollar surges. Silver drops 10% in the first hour. By the close, silver is down 15% from $75 to $63. Your 66.6 ounces are now worth $4,196. You have lost $804. You're down 16%, but you hold. Because everyone says this is just a knee-jerk reaction. The fundamentals have not changed, they say. January 30th to January 31st, the second margin hike. CME announces a second margin hike effective immediately. Leveraged traders scramble to post more collateral. Many cannot. They are forced to close their positions. Silver drops another 10% from $63 to $57. Your 66.6 ounces are now worth $3,796. You have lost $1,204. You're down 24%. You start to worry. But you still hold, because you believe in the long-term thesis. February 3rd to February 5th, selling pressure builds. Silver continues to drift lower as more traders exit. No major catalyst yet, just steady selling. Silver drops from $57 to $52. Your 66.6 ounces are now worth $3,463. You have lost $1,537. You are down 31%. Now you are scared. But you convince yourself to hold. It will bounce, you tell yourself. February 6th, the China announcement. China announces an easing of export restrictions. The market panics. The bullish narrative collapses. Silver crashes 15% in one day from $52 to $44. Your 66.6 ounces are now worth $2,930. You have lost $2,000 to $70. You're down 41%. You cannot believe it. You thought silver was going to 100. Now it is at 44. February 7th to February 9th. The third margin hike. CME raises margins a third time. This is the death spiral. Leveraged positions are liquidated. Silver crashes 20% in 2 days from $44 to $35. Your 66.6 ounces are now worth $2,331. You have lost $2,669. You are down 53%. You are paralyzed. You do not know whether to sell or hold. February 10th to February 12th, the algorithmic cascade. Algorithms take over. Momentum is down. Every algo on the planet is selling. Silver drops from $35 to $25. Your 66.6 ounces are now worth $1,665. You have lost $3,335. You're down 67%. You are in shock. February 13th to February 15th. The final flush retail capitulates. ETF outflows accelerate. Physical buyers disappear. No one wants to catch a falling knife. Silver crashes from $25 to $12. Your 66.6 ounces are now worth $799. You have lost $4,201. You are down 84%. That is how 5,000 becomes 800 in 45 days, catalyst by catalyst, drop by drop, until there is nothing left. Now let me show you why $12 is not extreme. Part 6, why $12 is not extreme. The 2020 precedent and the algo effect. Most people will say $12 is impossible. Silver cannot go that low. Miners will not produce at $12. Industrial buyers will step in. But that is not how panic works. Panic does not care about cost curves. Panic does not care about fundamentals. Panic only cares about one thing, getting out. And when everyone wants out at the same time, price can go anywhere. Let me show you the precedent. March 18th, 2020. Silver crashed to $12. Why? Because everyone needed cash. The COVID panic had hit. The entire world was selling everything to raise liquidity. Stocks, bonds, gold, silver, real estate, everything. And silver, being one of the most liquid assets, got sold hard. Did silver care that miners could not produce profitably at $12? No. Did silver care that industrial buyers needed the metal? No. Did silver care that there was a supply deficit? No. Silver cared about one thing: forced selling. And forced selling drove the price to $12. Now fast forward to 2026. The setup is worse. In 2020, leverage was lower. In 2020, retail participation was lower. In 2020, there was no major narrative to unwind. In 2026, leverage is extreme. Retail participation is euphoric. And the China export narrative is about to unwind. So if silver can hit $12 in 2020 during a liquidity panic, it can hit $12 in 2026 during a leverage collapse combined with a narrative reversal. Now add the algorithmic factor. In 2020, algorithmic trading was significant but not dominant. In 2026, algorithms dominate the market. And algorithms do not think, they execute. If the trend is down, they sell. If the momentum is negative, they sell. If key support levels break, they sell. And when algorithms sell, they create feedback loops. The price drops. More algorithms trigger, more selling. The price drops more. More algorithms trigger, more selling. This is called an algorithmic cascade. And cascades do not stop until the momentum exhausts. So if silver breaks below $20, algorithms drive it to 15. If it breaks 15, algorithms drive it to 12. And at 12, the cascade finally stops. Why? Because at $12, physical buyers return. Mints start buying. Industrial users start stockpiling. Long-term investors start accumulating. And the physical buying overwhelms the algorithmic selling. So $12 is the bottom. But getting to 12 requires surviving the drop. And most people will not survive. Because most people will panic, sell at 30 or 25. By the time silver hits 12, they will be out. Now let me show you what you must do right now. Part 7, your action plan, what you must do in the next 72 hours. Now let me give you the action plan. Because you do not have weeks, you do not have days, you have 72 hours to make a decision. Here is what you do based on your position type. If you are holding leveraged silver, futures, options, margin, you must exit now, today, this moment. Do not wait for a bounce. Do not hope for a recovery. Close your position and take the loss. Because if you are leveraged when the cascade hits, you will be margin called. And margin calls force you to sell at the absolute worst price. So exit now while you still control the timing. If you are holding paper silver, SLV, PSLV, other ETFs, you have a choice. Sell now and lock in your gains or losses, or hold through an 84% drawdown and hope for a recovery that might take 5 years. If you choose to hold, understand that ETFs do not always track physical during dislocations. The paper price can go to 12 while the physical premium stays at 20 or 25. So even if you hold, you might not capture the recovery. If you are holding physical silver, coins, bars, you have two options. Sell now at $75 and take your profit, or hold through the crash and wait for the recovery. If you sell now, you avoid the drawdown. If you hold, you need a 10-year time horizon and zero need for liquidity, because the recovery from $12 back to $75 might take a decade. Silver crashed in 2011 and never recovered to the highs. It has been 14 years. If you are thinking about buying silver, do not buy now. Wait, if the thesis is correct and silver is going to $12 by February 15th, why would you buy at $75 today? Wait for the crash, wait for the capitulation, wait for $12, then buy with both hands. That is how generational wealth is built, not by buying at tops, by buying at bottoms. Now here's the timeline for action. You have 72 hours. Why 72 hours? Because after 72 hours, we are inside 2 weeks from the Fed meeting. And once we are inside 2 weeks, liquidity starts to dry up. Bid-ask spreads widen. Dealers become hesitant. Premiums become unpredictable. And your ability to exit at a reasonable price disappears. So the window is now, not Monday, not next week. Now, 72 hours. Make your decision, execute. And prepare for what comes next, because the countdown has started, and there is no pause button. So here's where we are. 3 catalysts are converging on February 15th, 2026, the Federal Reserve meeting on January 29th, China's policy window in early February, the third margin hike by mid-February. When all 3 hit, silver crashes from $75 to $12. Your $5,000 position becomes $800, 84% gone in 45 days. Now let me be crystal clear about one thing. This is not a guarantee. This is my assumption. This is my framework based on the data, the catalysts, the leverage, and the historical patterns. But I could be wrong. The Fed could be dovish on January 29th. China could tighten export controls even further. Margins could stay flat. And if any of those things happen, silver could rally to $100 or $150. So I'm not telling you what will happen. I am telling you what could happen based on the current setup. And if it could happen, you need to prepare. Because the cost of being wrong is not symmetric. If you prepare for a crash and it does not happen, you miss some upside. But if you do not prepare and the crash does happen, you lose 84%. That is an asymmetric risk. And in asymmetric risk situations, you prepare for the worst and hope for the best. So this is my assumption. But the decision is yours. You have to look at your own situation, your own risk tolerance, your own time horizon, your own financial goals. And you have to decide, do I exit now or do I hold through the potential crash? That decision is not mine to make. It is yours. So let me ask you, do you think silver crashes to $12 by February 15th? Or do you think this entire thesis is wrong? Comment below and tell me. Share your assumption. Share your analysis. Share your thoughts. Because this is not about me being right. This is about all of us being prepared. And the only way to be prepared is to think through both sides of the trade. So comment below. And if you found this analysis valuable, even if you disagree with it, do 4 things right now. First, smash the like button. Not because you agree, but because this analysis took hours to research and you want more people to see both sides of the silver debate. The algorithm rewards engagement, so engage. Second, subscribe and hit the notification bell. Because I will be tracking these 3 catalysts every single day between now and February 15th. If anything changes, if the Fed pivots, if China reverses, if margins flatten, I will update you immediately. You do not want to miss those updates, so subscribe. Third, share this video. Send it to anyone holding silver. Send it to your friends, your family, your trading groups, because they need to see the bear case. They need to understand the risk, and you might save them from losing 84% of their capital. So share. Fourth, comment with your position. Are you holding physical, paper, leveraged? And what are you going to do in the next 72 hours? Exit, hold, hedge, tell me in the comments. Because your perspective might help someone else make a better decision. So like, subscribe, share, comment. 4 actions. Do them now. Because the countdown has started. Today is day 1. February 15th is day 45, and your $5,000 is on the clock. Do not say you were not warned.